let's talk about the economy for a little bit. And I'm going to suggest let's briefly look back and let's look ahead. Now, this is your financial team's perspective. You're going to hear our speaker in just a moment. But let me give you a perspective to consider. Well, actually, before I do that, scale of 1 to 4. 1 is I'm really pessimistic about what I see right now. 4 is, my goodness, things look so great in the economy and the markets. 1 to 4. Think about what number you would be. Do you take Obamacare into consideration? You take everything in consideration. Taxes, Obamacare. It does, Jerry. So 1 to 4. When 1 pessimistic, 4 positive. Who's a 1? Who's a number 1? Very pessimistic. Who's a number 2? Okay, I'm pessimistic, I'm kind of middle. Who's a number 3? I'm slightly optimistic. Okay, good. Who's a number 4? My goodness, things look so great. Okay. Irene, I see you. Well, let me tell you, how many really don't think about this? So, when you look at the evidence of the economy, think about the last 12 months and think about what we see. There is no disputing the fact that our economy is growing. Look at it in 3 different areas. Number 1, it's consumers. Consumers are buying more. Retail sales are up. Big ticket items, auto sales are up. That's usually an indication that people are more confident about the future. They're more confident in making a major purchase. Consumer confidence. Up until recently, consumer confidence was higher. Indicator that folks are willing to spend money. Interest rates are low, so consumers are starting to do what? Borrow more, yeah. A little bit disturbing, but they're borrowing more. That's exactly what the Federal Reserve wants, by the way. Borrow more and spend some. So consumers are really, as you buy more, then of course businesses expand and so forth. But think about consumers. Think about the third component, the second indicator of a growing economy, real estate. Think about where real estate is now in your neighborhood and think about where it was a year and 2 years ago. We've seen a dramatic difference. Prices are up, inventory's down, new construction's beginning. As new construction begins, people get hired. As people get hired, resources get purchased, and then retail clusters develop around those residential areas. So real estate is a big component of economic growth. The third area is businesses. Businesses are more profitable. They're selling more. In fact, they have what's called pricing power. You know what that means? It means that they can push their prices up and there's still a demand there. How many have seen higher prices for food and other items recently? Yeah. Yet what's the inflation rate? I think it's 1 or 2%. Consumer price index, it's higher, isn't it? So point is that businesses are doing better and they're earning more, they make more profits, they're trying to keep expenses what? Down. So they're trying to stay lean, which means they're hiring people, but they're hiring people at lower salaries, and they're reluctant to expand. Why are they reluctant to expand? Jerry, why are they reluctant to expand? Obamacare. And it is. It's one is the changing healthcare landscape. The other is taxes. And the other is, what's the biggest issue? The Congress and government. They see a stalemate there. So is that a good environment to expand the business? Not so sure. They're keeping money on their balance sheet nonetheless as higher profits. So you've got consumers, you've got real estate, and you've got businesses, and you've got the economy doing this. Now let's contrast that for a moment with the stock market. And it is different. The stock market typically is a proxy or a representation of the economy. Generally, economy goes up, stock market goes up. There are times when there's a little bit of a disconnect, when the stock market does better or worse than the economic indicators could support. Now, in some cases, the stock market might lead the economy, but in most cases, it's about emotions. It's about what happens. So what's occurring now? Well, think about the economy going up like this. Think about the stock market, maybe a 30-degree angle. Think about the stock market going up at a 45-degree angle, like this. What do you have? A gap. What's driving the market up different now than it was last year? Well, last year we had many economies do really well, including the US. Remember the information about Brazil and India and China and the BRIC nations, if you will. This year, we're one of the few economies that are doing pretty well, major economies. Brazil's not doing that well. India's not. China's flattening out. So there's more money from other nations flowing into where? Here. What do you think they're buying? They're flowing into the U.S. What do you think they're buying as money goes into the U.S. across our borders? Two things. Real estate. Real estate, number one. What else? I heard it over here. Stocks. So money's flowing in to buy real estate and stocks, and we're seeing the example. We're seeing prices firm up in both areas. So you got more money flowing in. Stock market is supply and demand like anything else. Market goes up. But there's a second and a third driver for the stock market that's happening this year that didn't happen as much last year. The second driver is there were a lot of people in 2009 that said, you know what, the Dow's down to 6,500 from 14,000. Hey, I'm not dealing with this. I'm not in there. I'm getting out. And what did they do? Go where? Bonds or cash. You know what the return of cash has been recently? So guess what? Think about the fact if you were in cash, getting 0.25% or less, and you just saw the stock market, the S&P, do 20% last year and 24% this year, what are you thinking? You're shaking your head saying, oh my goodness, did I make a mistake? And where does your money go? Into the market. What does that do? Provides more demand, pushes prices up. So you've got two things now. We've got money going in from monies that were in the money market fund previously. Money coming in from overseas is a third driver of the market that we see. Now think about the businesses I just spoke about. Businesses are holding on to what? Cash. So if you own a business, and you all do own businesses, by the way, because you own stocks in the form of mutual funds. You got cash. You can do one of three things with your cash. You can pay it out in dividends. Now, if they need to pay it out in dividends, they would do it. But dividends rate's pretty good right now. Interest rates are low, so they probably don't want to do that. Second thing you could do is pay down your debt. Well, if you've got bonds, because that's debt, at low interest rates, do you really want to pay it down? The third thing they can do besides more dividends, besides pay down debt, is what? Buy back shares, buy their own stock back. Guess what's happening? They're buying their own stock back. Now, not as much of late, but that's what they're doing. So when they buy stock back, what's that do? Makes the price go up. Why does it make the price go up? Oh, yeah, exactly. Okay, take shares off the market, lower number of shares, you got more demand, it pushes prices up. Remember Economics 101 for you that took that. So you've got three main drivers of the market. So this gap is developing. Now, it's uncertain how much that gap is. It's a matter of debate. And frankly, it's uncertain how long it's going to last. Could be 2 months, could be 2 years. Markets have had some pretty strong run-ups, think about the late 90s, for a long period of time. The point is we know that that's developing. So most economists are suggesting there's going to be one of two outcomes in the market. Yeah, I hear some chuckles there. First outcome, we'll call it a soft landing. Soft landing simply means that the markets are going up. At some point, the markets flatten out, economic activity increases, and there's a meeting there. You might see a small drop. In other words, the Fed stimulus is pushing the economy to higher levels. Economic activity goes up. And that could be from overseas sales or a number of things. But the point is that's what you see. The second alternative from a soft landing is a hard landing. What do you think a hard landing means? Not a crash. Let me be very clear. Not a crash. We're not in a situation like we were in 2008 or 2009. The fundamentals are completely different, and you can talk to Tim, Lucy, or myself, and we can tell you why. But it does mean that there would be a correction, an adjustment, however you want to term it. Maybe it's 10%, maybe it's 15%, maybe it's 20%. But remember, if equities have come up, if stocks have come up about 24%, we go down 20%, we've just given up this year's gains. It's important to stay engaged. Because yes, that's what we're seeing, but it's uncertain what the outcome is. Just know that that's what we're seeing. And like I said, also know that this could be 2 years or 2 months. We've got you in a well-diversified portfolio that really represents three elements. One is your unique goals and objectives that Tim, Lucy, and I have talked to you about. Second of all, the research and analysis that we do. What money managers should we use? How are they positioned? What allocations should we have? What changes should we make and when? It's all done by Adam's department. The third component is the season of the economy that we're in. Now notice I didn't say the timing. One of the biggest risks you can have in today's market is called concentration risk or timing. Concentrated too much in one area or you time it, you might be right about the outcome, wrong about the timing, you can lose. But if we recognize the season of the economy that we're in, which means that we're in a season of an expanding stock market, of continued economic growth, we see that happening, be prepared. We could see a market correction. Don't get too concerned about it if we have it, as we see it today. Could change as we see it today. So that's the growth side. That's the equity side. Now, the other area that I'll touch on before we bring up our speaker are bonds and interest rates. How many of you have recently read articles in the financial press or heard news broadcasters that would indicate or tell you you should get out of bonds? Okay? As in a lot of cases, the news doesn't tell the whole story. All bonds are not created equal. Let me explain why we have bonds in your portfolio. We've done it, Tim and I and Lucy have done this in meetings, but let me tell you in a broad basis here. Let me give some color to it. We call bonds foundation for a reason. So we don't call them bonds, but they're foundation. Think about what a bond really is. I had someone who talked about bonds, and they said, boy, bonds are so hard to understand. Well, they're quite simple if you think about it. They do have a number of moving parts different than stocks. Let me talk about that for a moment. You all have bond funds. So the managers are determining what bonds to buy, what bonds to hold, what to sell. Now, I've given this example to some of you before, but think about a bond fund, and let's assume we have a bond in it that's, let's say it's a Boeing bond. Let's say it's a $10,000 bond. Let's say it is a 5-year bond. Let's say it pays 3%. You can own the bond individually, own it in a fund, it's the same thing. Bottom line is very simple. As long as Boeing's around, in 5 years you get your $10,000 back. In the meantime, you get 3%. Simple, done. That's it. But there's a third value of a bond, or a fund, doesn't matter, same thing. It's called the market value. Now the market value is what you see on your statement. The market value is if you were to sell it as of the date of the statement. Just like the market value of a stock. The difference is the market value of a stock, there's no assurance that you're going to get some value back again. There's equity. More risk, more return, that's what it's for. So you think about it, let's say interest rates rise. Now, anyone remember in May of 2013, last May, our Fed chairman made a comment that affected interest rates in the bond market. Anyone know what the Fed chairman, Ben Bernanke, said? What was the term he used? Tapering. The Fed is going to taper. What the Fed's doing is basically printing $85 billion to stimulate the economy, keep interest rates low, and make sure that we as consumers can borrow and companies can borrow to expand. So what the Fed said, we're going to consider tapering. We're going to consider reducing our bond buying activity. What did that do to interest rates? Sent them up. June, we saw mortgage rates go up to, had the biggest jump that we've seen in 2 years. We also, by the way, saw the stock market go down in June. We also saw the value of existing bonds go down. So your example, your $10,000 Boeing bond paying 3%, a new bond, if it was issued by the same or an equivalent company at $10,000, would have had to be 4% to make it attractive in that marketplace. So your 3% bond is worth what? Less or more? Less, because that's be priced at the market. If you don't sell your 3% bond, are you still going to get the $10,000 back? Are you still going to get 3%? Yes, sure will. So what the bond managers are doing is they're looking at the markets just as we've seen it. Some are holding bonds, some are selling. Interestingly enough, we met with one of the largest bond management firms in the country that many of you have in your portfolio, this manager, PIMCO. We happened to meet them in our conference room. There's Adam and Tim and Jason, Lucy, and myself. We meet with these management companies once a quarter. And first question we asked is, what do you think about the market right now, and what are you doing at PIMCO? They said, we're buying. We're net buyers of bonds. What did it say in the press? Sell. Just here to tell you that you've got a well-designed portfolio. By the way, what did we do last year? Remember I said all bonds aren't created equal. Bonds can be 30 days in maturity or 30 years. And if you think rates are going down, you'd probably want to be longer term, wouldn't you? Think rates are going up, you'd probably want to be shorter term. Because what happens if you have shorter term bonds, rates go up, those bonds come due more frequently. You can renew at what? Higher rates. So last year we positioned all of you into more shorter term bonds. We moved your fixed income portfolio, so we have half of your portfolio in shorter term bonds. In fact, in just about all of your portfolios, we have some foundation investments that are 30 to 90 days. By the way, they're up this year, too. So I want to leave you with this comment about when we talk about bonds and we talk about the markets. And that is the fact that you've got a well-diversified and designed portfolio that truly is aligned with how we see the market. You see, we could see 2 years or 2 months of gains. Most of you have growth in your portfolio that will participate nicely in that. We're likely going to see gradually rising interest rates over time. Most experts believe it's not going to be dramatic. You're positioned for that. We've incorporated in many of your portfolios a fund called the Absolute Return Fund last year. That's a portfolio that is very dynamic in nature. Not stocks, not bonds, but it can invest in stocks, bonds. It can invest overseas. It can invest in gold, silver, real estate. It's used by pension plans, profit-sharing plans, and endowments. We have access to it. We don't have to meet their $10 million minimum. We incorporate in there simply because that's a manager that reacts very quickly to changing market dynamics. So we've placed all that in, and again, our hope, our goal, our desire is to be able to have constructed a portfolio that's aligned with your responsibility, aligned with your needs and objectives. And let me, and I'll do this in a group, any questions on that? If anyone has a general question about bonds. Was that helpful in bonds by a show of hands? Okay. Like I said, in the media, they tend to provide, the media is fairly good at telling you what's happening, what's going on. They're not so good at telling you a complete picture and not so good at telling you what's going to happen. So what we've done is taken that one step further and built that into your portfolio and be able to be very flexible with some of your portfolio and positioned appropriately with the other parts to relate to the economy as it stands today.